Good evening, folks. It's a lovely Wednesday evening here in Wirral. Fantastic. I think a good day. I've been out actually doing a bit of work on our syndicate fishing lake, putting some lime in. So it hasn't been a work day. It's been a rest day and a bit of mental health therapy. Being outside is always great. Sun shining, nice to do a bit of work outside. Good stuff. Anyway, reason I'm online. Guardian News 16 hours ago. Hugh Pill, who is the chief economist with the Bank of England, made a statement. He said, Hugh Pill says, and I'm quoting from the Guardian here, so it's their story, not mine. All credit to the Guardian for the story. Hugh Pill says rate cuts could fuel inflation resurgence, and there was noticed something on the news this morning about there had been inflation. Inflation had gone up last month. So he says rate cuts could fuel inflation and urges colleagues to be cautious before making further cuts. So what does he really mean by that? So what he means is the pace of UK cuts. So he doesn't want the Bank of England to go cutting rates every single month. So you need to take a bit of time, ease them down. So he's saying it's too quick at a time when pay packet increases remain strong. So after the election, certainly public sector workers benefited from pay rises. And not forgetting they hadn't benefited under a Tory government where there'd been payment freezes and under inflation rises for years. But all of a sudden they were given, I would say, reasonable pay rises. I wouldn't say great pay rises because they've already had massive cuts in pay, effective cuts in pay by under inflation pay rises and pay freezes. However, they were given decent pay rises. So he says pay pack increases remain strong and it could fuel a resurgence in inflation, according to Bank of England's chief economist. So he's the chief economist, yeah. He said on Tuesday that workers were proving to be more successful than previously thought at boosting wages. So basically, they're asking for rises and they're getting them. Now, whether you think public sector workers should get rises or not doesn't really come into it because they have been successful in getting them. Personally, I think they deserve them. I work with inside the public sector and I know firsthand what year on year under 1% and under pay rises and actual pay freezes does to your pay packet. So I think they deserve them myself. That's my opinion, like it or not. That's it. Anyway, they've been more successful at getting these pay rises. And this should give policymakers reason to pause before cutting the cost of borrowing again. However, an important however, he added that the path for interest rates remains downward, so it's going to go down over time. But what he's saying is don't do it as quickly. So Pill voted to keep rates on hold at a meeting of the bank's Monetary Policy Committee this month, when most of the 9 members group voted to cut rates by 0.25% to 4.25% overall. He said the quarterly pace of rate cuts since mid-24 have been too rapid and his colleagues should be cautious before making further cuts. And he's most probably right, to be fair. If we keep pushing rate cuts down, yeah, it's great if you're investing, but yeah, it could certainly fuel inflation. And whatever you think of, as an investor, if you've got buy-to-let properties, inflation's your friend, because it means when you borrow money off the bank, get the words right, so you get your mortgage, and if you're in the same mind as myself, you're not going to ever sell the property, you keep it, you refinance every so often, the mortgage value shrinks over time because of inflation. Inflation gradually erodes away your debt. So I'll give you an example. I bought my house originally back in 1999 for £42,000. You'd be paying that as a deposit these days. Yeah. But it wasn't back then. So it's a 3-bedroom semi-detached ex-council house, now worth circa 230, 240. So 20 years time, it's actually increased 6-fold. That's good investment to me. Pretty much 6 times its value. So the actual debt, I've actually paid off the mortgage on this property, not actually a year before. And I know some people say, never pay off the mortgage on your personal property. You're missing a trick. Okay? I'm not a financial advisor, but I can tell you what I did because my financial advisor advised me on this. I actually used my property to leverage bridging finance from lenders, not by a mortgage, but just by charging against the property. And because it's unencumbered, it allows me to do that. But that's by the by. So he's adding, I would characterise my May vote as favouring a skip within a continuing withdrawal of monetary policy restriction rather than a halt to the process or withdrawal. So what he's saying is he's not opposed to the rate going down over a period of time. He's just opposed to the speed it's going down. So financial markets expect 2 further interest rate cuts to bring it down to 3.75 by the end of the year, as policymakers attempt to support the economy during an expected period of subdued growth and increasing unemployment. While the economy grew at the fastest pace in the year in the first 3 months, 0.7% or whatever it was, apparently it was the fastest growing economy in the G7. I don't know, I'm just telling you what I read. The bank estimates the underlying growth rate for the rest of the year is going to be just 0.1%. So it's done all its growth in the first quarter. The rest of it is going to be pretty bad. That's what they're saying, bleak. So in recent pay-as-you-earn data, PAYE, has emphasised UK economy's weakness, with employers laying off workers in each of the last 3 months, which economists said was in response to higher taxes and rising global uncertainty after Donald Trump's tariff war, or whatever he called it. So I think what they're saying is national insurance rises have affected employers, and they've actually decided, well, they can't afford the extra income, the national insurance, and we're going to lay people off. How right that is, I don't know. Let me know in the comments whether you think that's right or not. I'm not sure. Okay. And Trump's tariff war, well, if you can call it a war, because he pretty much ran out of steam from what I've seen. He tried to bluff China and they just held the cards close to the chest and went, basically, F you. Canada saying, Mexico saying, they just bluffed him. We signed up to a deal, apparently the UK. I don't know how good it is, I haven't read the details of it. I wouldn't do a deal with that man because he quite obviously changed his mind as quickly as the wind will change over here. And I think he's suffering the consequences of that back home, even though Republicans are trying to put a brave face on it. I think Trump's days are numbered, but that's by the by again. I get easily distracted, I'm sorry. So the bank's governor, Andrew Bailey, I'm going back to the Bank of England, the interest rate cuts now, has said inflation was unlikely to have longer lasting effects on pricing behaviour when 2 members of this committee voted for half a point cut in rates in the last meeting, citing potential long-term damage to the economy from high interest rates. So some of them think it should be bigger cuts, quicker. However, Pill, as the chief economist, said he was concerned the structure of the UK labour market was becoming less flexible, giving employees the power to maintain their living standards through higher pay. Now, is that a bad thing that employees are maintaining their living standards through higher pay when inflation's gone up? I think that's a bit of a... I don't like the way he's phrased that, to be honest with you, because everyone's got a right to maintain their living standards, and everyone's got a right to be paid a fair amount of recompense for their work. He said service companies were continuing to award large pay rises, slowing the fall in wage growth. To me, wage growth needs to match inflation. I'm not a financial person, but if inflation's at 4%, wage growth needs to be at 4% to keep parity. That's my simplistic view of it. I might be wrong, I don't know. I remain concerned, this is Hugh Pill, not me, by the way. I remain concerned that structural changes in the price and wage setting behaviour have increased the intrinsic persistence of the UK inflation process. That not only makes inflation higher for longer in the aftermath of pandemic an invasion-induced inflationary shock, so Russia's invasion of Ukraine, that would have otherwise been the case. It also influences the appropriate bank response in pursuit of lasting achievement of the target inflation, he added. So that's the end of his article. So that's it. He's the chief economist of the Bank of England. He's not against rate cuts. He's just against the speed of rate cuts. What do you think? I can't see it going down that quickly this year, the interest rate. Personal view. I think we're into June next month. I don't see it going down in June or July. Maybe August. Don't know. To be honest, I don't even know if the Bank of England meeting has a month off in July or August for the summer. It made it. I can't see it going down this before September. Hey, I'm not an economist. I'm not the person pulling strings here. But that's just a personal view. What do you think? Do you think it'll go down, or do you think it's going to stay as the same? Do you think it could turn around and start going up again? Let's have a debate in the comments about this. Give us your views. See what you think. Anyway, that's the end of me for this evening. Have a great evening. Keep moving forward. Did I mention I've got a podcast? I'll put the link in the comments below. Efficiency in property investing. We've got a new episode every Monday. Please give it a try. Like, subscribe. Share if you can. Free to share. It means a huge amount to me, and I'm really grateful for any support. Anyway, as I said, have a great evening. I'm going out for a few scoops of beer because it's been a nice warm day. Do whatever makes you happy as well. Keep moving forward. See you next time.